there has never been a recession when corporate profit growth is positive, and right now it is. Not to say it can't happen, just hasn't happened ever. Hey everyone, welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management, and I'm here each week to enlighten, encourage, and educate you when it comes to your finances, because after all, your money matters. Now, today's show is going to be a bit data-driven. So every quarter, One Capital Management, our team here, our investment committee, we design something we like to call our financial playbook. I think it's fitting, given the fact that we're on the eve of football season coming up. And it's forward-looking of the highlights of the economy, both what's happened in the past quarter and what we are seeing in the future. And I want to share some of these data points with you today. And I'll try not to bore you, but it is important. Now, before we get into the data, smash that subscribe button and hit the notification bell so you don't miss a single episode. All right, let's get into it. Okay, so a couple highlights to start with. I've been talking about this a lot over the past couple months, capital markets that continue to see volatility, supply chain issues, the conflict overseas, inflation, rising interest rates, and of course, as of late, the discussion and fear of an impending recession. Now, despite the rising fear of a near-term recession in the US, something I've reiterated a couple weeks ago as well, there remain important ongoing strengths here. And I want to highlight a few of these strengths today. There are also things like corporate profits that we'll look at that are still rising in manufacturing and industrial production. They all continue to expand. As I brought up in a prior episode, are we in a recession? And if you have not seen that one or listened to that one, take a look, take a listen, because I think it's really important to understand the context behind what the media was loving to talk about as far as redefining the word recession. Again, I'm not trying to get political at that, but there's a couple of areas you look at for a recession, and the media only tells you to just look at GDP. Now, not just the media, to be fair, the by and large misnomer, I should say, and maybe it's inaccurate to call it that, but we all just think, okay, 2 consecutive down GDP quarters, obviously we're in a recession. But that's not the only indicator. Now, I'm not saying it's wrong to only look at that, but I'm just saying it's not the only one. And the overall job market, things like we look at constantly are still there. And I want to just stress this very openly. The job market in particular remained very robust. There is also something to note that household savings are still very high, historically high. So despite these many things grabbing our attention, and I think for many of you listening and watching, it's also stoking concern and fear about global economies and inflation and recession. Look, there are many good signs here to take note of. And I'm not trying to be the rosy guy here, although I do like to stay positive. We don't get paid really as advisors to be bullish or bearish. I just want to bring some stats and remind you each week of some of the things that we're not hearing in 140 characters on a Twitter feed or some red bar at the bottom of some news channel that you're watching or whatever it is you're looking at. There's a lot more there. But let's look at actually how the capital markets behaved. And by capital markets, I mean equity markets. As you might expect, given the headwinds facing capital markets and the equity markets, it's not much of a surprise. I think anyone who's seen this year in 2022 has produced negative returns thus far. But the normal ballast, by the way, in our environment of bonds provided, some shelter in the quarter. So the ballast of bonds provided some shelter if you look at it. Now, the fears of inflation, I think, obviously the rising rates and the overseas conflicts, they are all at the core of investor concern. So how has inflation hit our pocketbooks across the US? It's just some interesting stats to know here. I'm gonna label 5 here real quickly. Chicken is up 19%, unleaded gas up 61%, airline fees are up 34%, eggs are up 33%, and butter, oh, I love butter, up 21%. So food, gas, travel, housing, they're all rising quite rapidly. We've all seen it, that's not surprising. The underlying causes are what we need to understand though, because some of them are somewhat tricky, like labor costs, we'll talk about that, and others are what we'll call transitory travel as an example. Now, on the other hand, there are consumables that have declined in price over the last year. This is not being talked about. And this is not being, discussed heavily, like I mentioned. There's things like smartphones, uncooked beef, random things like, just to name a few that we notice in our data, are common household consumables that have actually declined the base effects and had a partial easing of supply shortages, in our opinion. Now, should all of those things come to light, they should push core inflation lower this year, but it will likely remain higher into 2023. I know so far I've not shared anything dramatic and eye-opening or jaw-dropping, but essentially what I want to go through here is we're going to come off of these highs of inflation. We just saw it recently from the 9.1 down to the 8.5. Doesn't seem like a huge shift, but it's actually quite large. And we're going to see that kind of dwindling down, but it's still going to be somewhat high. Now, it's interesting to note, gas prices in the US are already coming down. We've all seen it. As you saw, the majority, actually specifically exactly half as of August 7th, according to AAA, of gas stations in the United States are already charging less than $4 a gallon. Interesting note. Now, this is not necessarily in California from our headquarters here at One Capital, but across the board of the United States. It's important to see now these inflation pressures pushed the Federal Reserve to adopt a more hawkish stance. And for those of you that have heard that term recently in the news from the Fed, when you see the Fed being hawkish, they're going to be more aggressive. The other adjective they'll use is dovish, which means they'll be a little bit more passive. And talking about hawkish and by aggressive, what they are meaning is they are trying to tackle it. And you've seen this when the interest rate is nearly tripled and quadrupled in the past 7 or 8 months. And I want to bring something to light here because there's two sides to this coin. And I want to talk about bonds for a second, going back to that ballast for all equities and portfolios. I know bonds, I know it's boring and it's like, why is this guy talking about bonds? It's like the least sexiest thing in the world. But know this, it is bonds that run the market. I mean, 30-year fixed mortgages are set on these. We see treasury notes and T-bills and all this kind of stuff out there are just really good indicators of things, and they all back up against bonds. They're also a great diversifier for any portfolio. They are the ballast that we measure our aggressive versus conservative portfolios on to make sure that we are managing it appropriately. And the most challenging bond market in history was the culmination of the shutdown of the economy in 2020, and then the subsequent resuscitation and then very robust recovery, leading to this now inflation and the need for central banks to basically tap the brakes by raising interest rates and getting hawkish. What happens is the 2-year treasury rose by about 2.19% and the 10-year by 1.46 in just the first 6 months of this year. Quick pause here. What does that mean? Essentially, you're getting like basically 0 to like maybe 0.5% if you're lucky in a savings account. I mean, right now you can go and get a 2-year treasury note, 1-year, 3-year, maybe even 3-month treasury notes that are redeemable next day. And you get 1, maybe 1.5% because the general rise in short-term rates allows assets to also rise. That's where you see this short-term, long-term. So some of the conversations I've been having with clients here at One Capital that have cash needs or shortages, we can actually go and get really good security now with decent interest rates. Now, it's all relative, right? For any of you watching who lived through the 70s and 80s, you saw mortgages at 16, 17, 18%. Paul Volcker of the Fed and Reagan, when he came in the 80s, let interest rates run wild a little bit because they were trying to slow the money supply. That's something we've been preaching and we hope to see here from our Federal Reserve right now is to do not just rise the interest rate, but also curtail the money supply. When I say it's relative, when you have a CD in that time period paying 6, 7, or 8%, but you have mortgages paying 18, you're still somewhat equal, right? Versus now you're paying, or last year I should say, paying mortgages of 3 or 4%, and the banks are paying you nothing. Everyone wants to moan over the fact you're paying nothing, but your rates of debt are so low. So it all kind of goes together. Again, two sides to the coin. Now, relative to inflation, it's still subpar, let's be honest, but it's way better than where it was, a couple months ago. So while a sudden jump in rates shocked the bond markets, and now the higher rates will lead to a slowdown, which is the whole point of this whole thing in the pace of growth. Raising rates, slow the economy down, cool it off, let the money supply come back in check. Now, this perhaps might lead to a recession, which many have talked about, and I talked last week on our show about this, and I have stated, as we feel currently, we are not in it yet. We are kind of going towards that way, and it's essentially what means by stalling out the economy. But investors, everyone listening, myself included, all benefit from now higher prevailing rates on bond allocation. So understanding your bond allocations relative to your equities is probably key point number 1 in some of the data I just provided here. Now, again, for every bad, there's a good, and we have to find that and make sure we mix the two together. That's our job as fiduciary advisors. And that's how we diversify assets and essentially diversify risk. And that's what's really how we want to look at portfolio management. If you take the emotions out of investing, it can become very clear on the rationale that you need to use the 2Ds of what I call every week, discipline and discernment. Now, switching over to the equity side for a second, coming from bonds to equities, let's look at valuations. Valuations are returning to long-term averages as the current forward 12-month price to earnings ratio for the S&P 500 across the board is about 18.6. This PE ratio is equal to the 5-year average. And while still elevated above the 10-year, about 2 points, it's quite reasonable with continued expected economic growth. Great, Brad. What does that mean? Price to earnings growth is one of the most key fundamental indicators of valuations for a company. Not the only indicator, but a key one. You typically want a company trading between 16 and 18 times multiple, as they say. Now, quick context for a second. Price to earnings multiples in years like 04, 05, 06, 07, kind of leading to the Great Recession, they were trading at upwards of 25 plus. Now, when you have the conversation with clients, or if you are watching or listening right now, when you're out there kind of thinking like, oh, they'll call stock expensive. When someone says it's expensive for a stock, they're typically meaning it's an expensive per share price. Amazon's a great example before their split and all their kind of things that they do. Like it was just expensive. It's high per share cost for us as investors. Well, you should know the real way you want to look at expensive or cheap is at valuation, at price to earnings. It's one indicator. Essentially, we want that bandwidth between 16 and 18 times. So if it gets higher than that, you start seeing, is it really worth investing in right now? Because I'm not sure I'm going to get back into that time frame that I want if it's trading in the mid 20s. So when you look at a 12-month, 1 year forward looking price to earnings ratio, currently at 18.6, that to us means valuations is pretty strong. And the price to earnings multiples have actually regressed. They've actually come down since the start of the year. So profit growth is another one, which is another key important point here, also remains very strong. Now, I want to be very open about this. It's important to note here, this is big for everybody listening. There's never been a recession when corporate profit growth is positive. I want to say that again. There has never been a recession when corporate profit growth is positive, and right now it is. Not to say it can't happen, just hasn't happened ever. So the question comes to many, is this, can this continue in the face of all these growing headwinds? And you got to ask, well, will earnings deliver? That's the whole point about future looking here and forecasting. So with the comfort that profit growth remains strong, as I mentioned, and that there has never been a recession when corporate profit growth is positive, we need to look at that, both current and forward earnings estimates, since future earnings are what drive the equity market. So for the second quarter that just ended, with 87% of companies currently reported, the blended earnings rate for the S&P 500 is 6.7%. And notably, this is big, revenues increased by 13.6%. So looking forward, consensus estimates estimate a slowdown in the growth rate, but still growing in a full year report of nearly 9%. Context, ladies and gentlemen, this is the kind of thing I'm bringing up here on the Make Your Money Matter show when it comes to these 2 consecutive quarters of GDP and solely and myopically focusing on just that. You have to look at growth, you have to look at forward earnings and valuations and being strong all around those kind of things and looking at other indicators. And let's actually talk about some other signals, some other indicators with regards to this recession conversation. So there's a couple signals that you want to look at. Unemployment, consumer confidence, that's a big one. Corporate profits growth, I just mentioned that. Yield curve and leading economic indicators, growth averages, hourly earnings growth, all of those kind of indicators. I mean, there's a lot of things kicking off here that if you look at certain time periods, like again, not that long ago, the great financial crisis, the dot-com bubble, even 2020, all of those things I just mentioned, those 6 things all hit as huge warning signs of a recession. So we don't have all of those markings for a recession right now. We have 3 of the 6 primary indicators that are flashing recession, but very important ones, the ones I just mentioned, unemployment, corporate profits growth, are all holding strong. So if I go through those again real quickly, in all this recent era of the dot-com bubble, the great financial crisis, and again, not that long ago, 2020, they all had recession currently. And right now, these things that are signaling a recession, are basic. They're average. I mean, average hourly earnings growth, the yield curve, and consumer confidence, those are all showing recession. I think the biggest one, consumer confidence. I mean, you look at consumer sentiment, it's a big part of our economy now. None of us are that, positive around what's going on. There's a lot of stuff being thrown at us right now, but those are all negative, which is basically what the media is showing you right now. But what's not negative, again, unemployment, high, corporate profits growth, positive, and leading economic indicators, the LEI growth in particular, leading economic indicators, is fallen actually from prior highs, but it's not negative. So far, we are just not there yet. I wanted to clarify last week's discussion around recession and those kind of topics and look at other indicators. I mentioned other indicators, but I wanted to specifically label them out. Now, I know that may not sit well with some of you. Like, why would you say that? I mean, and I mentioned this before, I almost want everyone to just call it a recession. I want these indicators to be like, let's just all call it a recession. You know what I mean? Like, we're all just going to get it over because, again, does it really change our mindset about how you've looked at this year, 2022? It's been volatile. We've seen gas prices up. We've seen a lot of just negative energy around. We've seen everything around us go up. We've seen that we try to order something and it's like a backlog. Like, we're seeing all these signs, but labeling it a recession, we really have to look at it from an economic perspective at all those 6 indicators. And again, so far, not a recession. Now, these 3 important indicators have yet to signal that the U.S. is imminently headed for a recession. So leading economic index is positive, and it has a way to go, and it has a way to signal a recession. Again, I want to go back to one thing. The aforementioned corporate profits and really finally the employment conversation we've been having all remain very strong. There's an indicator called the SAHM, S-A-H-M. It's the SAHM Recession Indicator. It signals the start of a recession when the 3-month moving average of the national unemployment rate rises by a half percentage point or more relative to its low. So during the previous 12 months, this indicator is based on what they call real-time data. That is the unemployment rate and the recent history of unemployment rates that were available in a given month. So the BLS revises the unemployment rate each year at the beginning of January when December unemployment rate for the prior year is published. Did you catch all that? So revisions to the seasonal factors can affect these estimates. And in recent years, it has done that. So otherwise, right now, the unemployment rate does not revise. The strong U.S. job recovery is still continuing. We are seeing this. I mean, there's a help wanted sign everywhere I pass. I'm sure you've seen it too. It remains historically high in terms of the number of job openings per available worker, which is driving continued wage pressures and wage growth that are currently 4%. They're over 4%. They're inflationary. So that's what we are seeing right now. We are starting to see companies out there making job cuts, but overall layoffs are slowly rising according basically to weekly unemployment claims. Again, other indicators with the look at job openings are basically, they're starting to fall off a little bit, but there are still nearly 2 jobs for every 1 unemployed worker. I want to restate that. There are nearly across the board in the United States, 2 job openings for every 1 unemployed worker. So aside from some of these stats, the last thing I want to put, to put a bow on here is consumer finances. All of our cash and our monies. I mean, Americans across the board are still holding significant cash balances, which is allowing them to continue spending. Part of our problem right now is we have a growth in money supply. Now, as I mentioned a few weeks ago, one of the things that the Fed needs to do, and I'm really calling on them to do it, is like when I studied Paul Volcker and the Fed years ago during the Reagan administration, what they did really well was they let interest rates rise, but they also were tackling money supply growth. That's a big deal, right? You have 18% increase in basically the last year of the money supply, and you only have a 9% increase in goods and services. Friends, that's inflation. You still have a 9% surplus of too much money chasing too few of goods. So you can raise the interest rates all you want, which will stave off some purchases, but you still have a ton of cash, specifically $2 trillion across this nation of Americans, you and I, sitting on cash waiting to buy things. So you can look at that in 2 sides. It's going to continue to bring pressure on the inflationary side, and the Fed will do its best to try to raise rates, but it may disqualify some people wanting to buy certain things, houses and maybe cars and other debt like that. But there's still a ton of cash sitting there ready to be deployed. So to wrap this wonderful week's episode of the Make Your Money Matter show of a bunch of data and all this stuff we've been going through here at One Capital Management that I wanted to share with you, all of you watching and listening, all the so-called negatives, they're all impacting the consumer confidence and the investor sentiment. This is largely why we've been seeing a lot of this volatility this year. But if you look at and noted what I said a few minutes ago about the expected future return, decline in stock prices, raise expected returns. So again, I've said this before, I'll say it again, discipline and discernment will always win out. And I do feel like everyone's situation is different. That's why you want to meet with your advisor, and if it's with us, if you're listening right now and you're a client, give us a call. We always do a review with you. You know that if you're not a client right now, give us a call. We want to go through this data with you because before you just go away into a corner and say this world's gone mad. I mean, there's a lot of things going on, but when you look under the hood like we do and really truly understand, take the time to truly understand and know what you're looking at, there's other signs to look at here that we can look far out. And I do believe any investor right now who stays true to their discipline will be rewarded. The ones that are going to be affected by this are the ones buying into this negative consumer sentiment. And I'm not trying to be, the rosy guy here. And the glass is always full, but you look at it, again, under the hood, and you got to really see that, look, this engine needs some tune-ups. It definitely does. That's what we're seeing right now in the American economy. And we're going to continue seeing it here into the end of the year. But there's a lot of really great things to do. And I think when you put that data into context for your plan, it helps you build the right portfolio. Okay, it's time to answer your questions. If you have a question or topic you'd like me to address, you can leave a comment or question in the comment section. Or if it's something a bit more personal, you want to go through one-on-one, just go to the About page on this channel and send us an email. We'll always keep our questions I read here anonymous, so you never have to worry about your name being shared, but we'd love to hear from you. So the question that came in today had to do with volatility, which we talked about, a lot today. We've talked about on the show recently. How do I keep my head out of, or my emotions out of this volatility? It's a great question. I think all of us deep down subconsciously are dealing with it. It's hard when we have our phones next to us at all times and we have all this stuff, just live feeding through to us. So one thing I'll say, there's some really simple ones to do it is, turn off certain channels you're watching just to kind of make sure you're not getting fed daily on all the negative stuff. And then I think keeping focus on the end goal. I talked a lot a couple weeks ago about, goals and things like that when it comes to your planning and bucket planning. We talk about it throughout pretty much every show when it comes to, growth without a plan really isn't growth at all. So you got to have kind of the roadmap you're going down. If you stay focused on what you're going forward, I know that may sound really cheesy, but it actually works. Like you just kind of, you forget what's, the end game. Think of like a road trip, right? One that's not a scenic road trip, let's just say. You have to get from point A to point B. You're going to forget some of the bushes that you saw, right? If you focus on the bushes the entire road, that's all you're going to think about. You're going to think, oh my gosh, I'm seeing bushes and bushes and bushes, and this road trip is taking forever. So you kind of have the same thing when it comes to investing. If you focus on everything that's thrown at you every other hour, whether it's through Twitter or a news feed or whatever it is, it's a really easy way to get distracted. Even the most disciplined investors I've seen, most disciplined clients have been thrown off by, sometimes there'll be just some sort of news blip that'll hit your emotions one day, having a, maybe you have a cathartic thing happen in your life or something just gone on and it just kind of erupts you and it changes your courses. So I know it's kind of a long-winded answer to that, but I think avoiding the volatility is remembering the 2Ds, discipline and discernment, setting your course and sticking to it no matter what. That matters. I know it's a really simple thing and we do it in everything from our daily lives to working out to diets. If you stick to it, okay, if you stick to the discipline, it will work. The only time you can choose, test this. It's the same thing for investing. Anytime you set a course out and you deviate from that, you're going to get different results than you intended, right? Same thing with investing. And yes, there's a lot of blips, there's things like that. And the idea about the valuations I talked about today is when you see lower prices in stocks, that's a time to kind of devour those because they're at lower valuations than they really should be. Not across the board, but a lot of them are based on consumer sentiment and other data that's just bringing volatility down. So you want to kind of lick your lips a little bit and say, okay, I want to, now that stock I was going to buy for $20, 7 months ago is now at 15. Did it really change? That's the idea about fundamental valuation, research is understanding, did something underlying change to the company itself, the sector or the industry, and do we see that changing in the future? That's kind of tying in the notion of how do you avoid volatility to understanding what we were talking about today. I know it was a lot of data, but understanding valuations in terms of their forward-looking earnings and what that means for your portfolio and how to stay the course with your discipline. So again, if you have a question or comment you'd like me to read here, again, leave it in the comment section or email us in the About page on our channel. Now, before we go, if you found anything helpful today and want to learn more, You can visit our website at onecapital.com. You can also scan the QR code on the screen with your smartphone. It'll get you right there. You can also call or text us. We want to help. Listen, there's no pressure here. We don't treat people like a number. In fact, we value the relationships. It's the lifeblood of what we do as advisors. So click, call, or text us today. Now, if you're not following us on social media, you should be. You can follow us at Make Your Money Matter. We're sharing great information on all of our social media platforms. And as I often say, if you enjoy the show, share it with someone you like. And I guess if you don't like the show, share it with someone you don't like. But until next time, make your money matter.